Jim, what do you think? I know that there's this wall of worry that you've talked about out there. Why do you think that's a good thing, and what do you think is most likely to happen here?
Well, I do see the continuing wall of worry. I mean, this whole bull market, Becky, started with a wall of worry and has never really totally gone away. I mean, I think that's what we have now still, by and large. I mean, we just got an illustration right in your face of risk in the December swoon, up close and personal, how quick and how ferocious a bear market can be. That doesn't quickly leave the imagination of investors. And then we had a technical inverted yield curve. We're coming up here just in another month or two we're going to be in the longest recovery ever in U.S. history, which makes you feel like how much longer can this go on? We're worried that policy officials are out of bullets to do anything. We've got a slowdown here and globally. I think we're still climbing that wall we're in. It tells me we got a lot of portfolios that are underinvested, waiting for this to end, if you will, and don't want to be caught overinvested if it is going to end. And if it continues to go on, I think they're going to have to reduce their underweights, even if they don't go full bullish. And that's a pretty good driving force. But I also think, we revalued this stock market. It's now at 19 times trail. It was 20 right before the collapse and 23 early in 2018. We've reduced the competitive interest rate down from 3.25% on the 10-year to 260, which makes that PE multiple look even more attractive. We paused the overheat pressures that were giving us so much trouble last year. We brought the full policy cavalry of monetary and fiscal accommodative policies, both here and globally. And then we're still climbing that wall of worry. So I think the chances are that we are going to set new highs, but I'm starting to wonder if the real surprise would be we don't just go up to 3,000 or something, the S&P, but maybe we go quite a bit higher, at least for a period of time. If you go to 20 times earnings on street estimates of about 165 to 170, that'd be around a 3,400 S&P, and certainly is possible, I think, before the year is out.
Jim, looking at the bond market, a lot of people wonder whether we've seen rates peak for this cycle, but you disagree. You think yields are going to rise again?
I do, Wilf. The rise that we've had, I think, in the stock market primarily is due to the fact that we paused overheating. We took the Fed from a foe to a friend, and that's created the rise. The next level of this market rally could be when people come to appreciate not only are we not going to recess, but we're recovering to some degree. So you not only not have a decline in earnings, but they'll start rising again. And if that happens and the growth continues, then at sub 4% unemployment rate, we're going to bring back overheat pressures. I don't know how soon, might not be till next year, but they're going to come back if we grow with a sub 4% unemployment rate. So eventually, I think we're going to see pushing bond yields back above 3% towards those old highs we had last year.
So you like the kind of more cyclical exposure then, rather than defensives?
I do. I would be overweight away from the United States. I like the international markets better than I do the United States markets, both developed and emerging. But here, I would own some defensive sectors, no doubt. But I think I would tilt away and look at a couple things. I'd look at weak dollar plays. I think that could be another big thing happening yet as the dollar breaks south. And if it does, that's going to boost commodity prices in general and help materials and energy and industrials in particular. I would look at the beat-up financials here. If the recovery continues, the yield curve re-steepens, loan growth continues, I think it's going to, that value play could be attractive. And I would still tilt your portfolio a little more towards small caps, particularly since they pulled back here this year. And away from the large cap popular names.
The dollar's going to turn south, but I thought you just said you thought there was a bigger risk of overheating here and the Fed having to come into play. I mean, that doesn't look likely for most of the other developed markets, central banks.
Well, I think the weak dollar will, if it occurs, will add to overheat pressures. Weak dollar would bring more demand to the United States. It would put more pressure on our resource markets, and it would be inflationary. There's a kind of a direct link as the dollar goes down, commodity prices go up, and I think that would promote overheat. But for a while, right now, given the attitudes of where investors are, I think a weak dollar would actually reduce recession fears and cause more and more people to think this recovery is going to continue for a period. So initially, it'd probably be bullish for earnings, ultimately negative for overheat.